IVV is described as a simple way to own the S&P 500. That description is accurate, but incomplete. IVV's long-term behavior is shaped by index rules, weighting mechanics, and rebalancing, not by the price chart. For portfolios where IVV is a core holding, those mechanics matter far more than short-term performance. IVV is the iShares S&P 500 ETF. It's designed to replicate the performance of the S&P 500 through a fully passive, rules-based structure. IVV doesn't try to outguess the market. When you hold IVV, you're holding the exposure to the core of the US large cap equity market. The S&P 500 is not a simple top 500 by size list. It's a committee managed selection of US large cap companies. To enter the index, a company needs to meet several criteria: minimum market capitalization, sufficient trading liquidity, US domicile and primary listing, and a track record of profitability. Two companies can be roughly the same size, but only one of them may be in the S&P 500. The index is rebalanced and reviewed regularly. Companies can be added, removed, or reweighted. IVV doesn't weight every company equally. It follows the S&P 500's market capitalization weighting. In a market cap weighted index, a company worth 1 trillion carries 10 times the weight of a company worth 100 billion. As market values change, those weights adjust automatically. If a business stagnates, loses relevance, or declines, the index quietly reduces its influence. The consequence of this structure is concentration. A relatively small number of mega cap companies can represent a large share of the index. When you buy IVV, you're not just buying the stock market, you're buying a weighted snapshot of where US corporate profits are being generated right now. Inside IVV are all major sectors of the economy, but they're not equal and they're not static. Technology grew as software, cloud computing, and semiconductors became core economic infrastructure. Communication services evolved from phone networks into digital platforms. These shifts are not discretionary decisions. They emerge automatically as companies grow, shrink, or lose relevance. That has consequences. Sector weights shape how IVV responds to interest rates, how sensitive it is to economic cycles, how exposed it is to regulatory and policy changes, and whether returns skew more growth oriented or defensive at any point in time. Zoomed out, IVV looks like a smooth, upward sloping line. That line is built from distinct market regimes, expansions, crises, recoveries, and sideways periods, each with different risk characteristics. But treating all environments the same leads to poor decisions. An expansion regime rewards equity risk, a crisis regime demands liquidity awareness and tighter risk control. The long term trend survives, but the path is uneven. Now look at returns through the lens professionals actually use. Take every possible 1 year holding period over the past few decades, then 5 year and 10 year. 1 year rolling returns are wide ranging, large gains and deep losses coexist. 3 year returns remain volatile, but extreme outcomes occur less often. 5 year returns cluster more tightly, with far fewer negative windows. 10 year rolling returns are historically skewed positive, with losses becoming rare. That shift from point forecasts to probability ranges is how professionals think about long term equity exposure. If you only look at IVV's price chart, you're seeing an incomplete picture. Many companies inside IVV distribute a portion of their profits as dividends. Those cash payments don't appear in the price line, but they compound quietly in the background. Ignoring dividends understates long term returns, sometimes by a wide margin. A total return view assumes those dividends are reinvested. During market declines, dividends buy more shares at lower prices. During recoveries, those extra shares participate fully in the rebound. Over long horizons, this creates a widening gap between price only returns and total returns. Fees work in the opposite direction. IVV's expense ratio looks small on an annual statement, 0.03%, but every basis point in fees is a slice of index return that never compounds for you. Over decades, the difference between a low cost ETF and a higher cost fund is not subtle. It shows up as a permanent reduction in terminal wealth. Price charts understate realized return. Total return is what actually matters. IVV's risk profile is not constant. Periods of calm are often followed by sudden stretches where daily swings widen and uncertainty accelerates. Volatility doesn't arrive as a steady average, it arrives in clusters. These higher volatility phases typically coincide with economic recessions, credit stress, policy or rate shocks, and geopolitical events. In low volatility environments, equity risk is easier to tolerate and drawdowns feel contained. In high volatility environments, outcomes are driven less by expected return and more by liquidity, drawdown depth, and investor behavior. Volatility clustering matters for preparation, not prediction. A drawdown is the decline from a previous peak to the current price. Mathematically, drawdowns are not a flaw, they're the cost of earning equity returns. Without the possibility of deep, temporary losses, there will be no reason for markets to offer a long term equity premium. What makes IVV structurally resilient is not that drawdowns disappear, it's how the index reconstitutes itself afterward. Underperforming companies lose weight, stronger companies gain influence, weaker firms are removed and replaced by stronger entries. IVV is designed to be a primary growth engine, not a complete portfolio by itself. On its own, it doesn't diversify equity risk, it concentrates it. Trying to make IVV safe misunderstands its purpose. Its role is growth, not stability. Stability comes from how IVV behaves relative to assets that respond differently under stress. High quality bonds may hold value or rise when equities decline. Other assets can hedge inflation risk, policy shifts, or economic shocks. IVV converts volatility into long term expected return. Risk control doesn't come from changing what IVV is, it comes from what you pair with it. IVV supplies growth, other assets provide balance. IVV is used at scale because it can absorb large trades without distorting price. For institutions, this means moving significant capital with minimal slippage. For individual investors, it means fast fills and low transaction costs. Without this liquidity structure, large trades would push prices away from fair value, penalizing both buyers and sellers. The mechanism that prevents that is the creation and redemption process. Specialized firms, called authorized participants, can create new IVV shares when demand is high, or redeem shares when supply exceeds demand. First, price alignment. If IVV drifts away from the value of its underlying holdings, arbitrage activity pulls it back into line. Without this mechanism, IVV could trade at persistent premiums or discounts. Second, tax efficiency. Because securities are exchanged in kind rather than sold for cash, the ETF significantly reduces the likelihood of capital gains distributions. Without in kind exchanges, turnover would create taxable events that quietly erode returns. The result is an instrument that scales cleanly, from small individual accounts to institutional sized allocations, while staying tightly linked to the index and minimizing unnecessary friction. Long term individual investor. Regular contributions through dollar cost averaging reduce entry risk. Pairing IVV with bonds or cash helps manage volatility at the portfolio level. Trying to trade in and out of equities introduces timing risk. Using IVV focuses the decision on staying invested through drawdowns, where long term returns are actually realized. Financial advisor or model portfolio. For advisors, IVV often sits at the center of a core satellite structure. Smaller satellite allocations, value tilts, small cap, or themes are layered around it. IVV's transparency and consistency simplify rebalancing and allow advisors to maintain target risk profiles across many client accounts simultaneously. Institutional allocator. The decision comes down to trade offs: liquidity, trading costs, financing, and transparency. More complex instruments may reduce marginal costs. IVV reduces operational risk. Institutions use IVV when transparency, simplicity, and clean execution matter more than marginal cost optimization. IVV removes layers of complexity, but it doesn't remove risk. When US equities fall, IVV falls with them. Simplicity reduces decision risk, but it doesn't eliminate market risk. Because the index is market cap weighted, concentration risk is real. A relatively small group of large companies can dominate performance. For non US investors, currency movements can amplify or offset returns. IVV is designed to deliver efficient access to broad equity exposure. Accepting its risks is part of earning its long term return. For long term holders, success with IVV is less about selection and more about behavior. Successful implementation typically comes from choosing an allocation that matches true risk tolerance, contributing on a consistent schedule, accepting that drawdowns are part of the process, and resisting the urge to abandon the strategy during volatility spikes. Once behavior aligns with structure, IVV becomes what it's designed to be: a low friction, scalable, transparent way to own the productive capacity of major US companies over long horizons.